So, hi everyone. We are going to present to you the chapter 20 entitled Sharing Firm Wealth, Dividends, Share Repurchases, and Other Payouts. This will be presented to you by yours truly, Michelle Sancincel, and my group mates, Trisha Blesa and Drew R. Pereño. So for the objectives after studying this chapter, you should be able to first define dividends and enumerate the types of dividends. Second, know the advantages and disadvantages of paying dividends and why investors favor capital gains. Third, explain the concept and theories of dividend policy. Under this, dividend policy irrelevance theory. Next, dividend policy relevance theory. And the last theory is the residual theory of dividends policy. For the fourth objective, we have to discuss you will be able to discuss the factors influencing dividend policy. Next, explain the types of dividend policies. Under this, we have stable dividend policy, constant dividend payout ratio policy, and regular dividends plus extra policy. 6. Note the types of dividends, in example, cash and stock. 7. Understand stock splits. Next one, explain stock repurchase as an alternative to cash dividends. And lastly, you should be able to understand dividend reinvestment plans. Now let's start first by defining dividend policy. So it is an important subject in corporate finance and dividends are a major cash outlay for many corporations. So why is that? Because at the first glance, it may seem obvious that a firm would always want to give as much as possible back to its shareholders by paying dividends. And it might seem equally obvious, however, that a firm could always invest the money for its shareholders instead of paying it out. And the question in the heart of the dividend policy is, should the firm take that money and invest it for its shareholders? Just like others, paying dividends also has advantages and disadvantages. So let me tackle first to you the advantages of paying dividends. First, cash dividends can underscore good results and provide support to the equity share price. Second, dividends may attract institutional investors who prefer some return in the form of dividends. A mix of institutional and individual investors may allow a firm to raise capital at lower cost because of the ability of the firm to reach a wider market. For the third advantage, equity share price usually increases with the announcement of a new or increased dividend. And the last advantage, dividends absorb excess cash flow and may reduce agency costs that arise from conflicts between management and shareholders. Let's now move on to the disadvantages of paying dividends. First, dividends are taxed to recipients. Second, dividends can reduce internal sources of financing. It may force the firm to forgo positive net present value projects or to rely on costly external equity financing. And for the last disadvantage, once established, dividend cuts are hard to make without adversely affecting a firm's equity share price. Why do some investors favor capital gains? To explain that, when a firm pays out dividends, all shareholders share in the dividend distribution, and all must pay taxes on those dividends as income in the tax period. The firm may instead retain earnings, consequently causing share price to increase over what it would have been if the firm had paid dividends. Only shareholders who want the equivalent of a dividend will sell equity shares, thereby incurring the obligation to pay capital gains taxes. And investors who do not need or want any cash will not sell their stock, and they therefore will not incur any obligation to pay taxes on capital gains until they choose to do so. Note that this ability to time tax assessments will be especially attractive for investors who expect their capital gains tax rate to decline over time. Not only will these investors will be able to push the tax bill off into later in the future, they may also be able to reduce the total tax in doing so. For the concept of dividend policy, a dividend policy involves the decision to pay out earnings or to retain them for reinvestment in the firm. A dividend is a distribution of earnings to shareholders generally paid in the form of cash or stock. A retained earning is the portion of after-tax earnings not paid out as dividends, and the dividend payout ratio is the percentage of earnings rate paid to shareholders in cash. It is said that dividend policy is important because it affects investor attitudes and the firm's financial structure, flow of funds, liquidity, growth rate, and cost of capital. And the goal of dividend policy is to maximize its contribution toward increasing shareholder wealth. An optimal dividend policy strikes that balance between current dividends and future growth, which maximizes the price of a firm's stock and shareholder wealth. Selecting the optimal dividend payout rate that achieves this balance is difficult for most companies because numerous factors influence dividend policy. So a number of factors influence dividend policy, including the investment opportunities available to the firm, alternative sources of capital, and stockholders' preferences for current versus future income. And the major goal of this chapter is to show how these factors interact to determine a firm's optimal dividend policy. It is said that managers often believe that dividends are important in affecting the value of their firm's ordinary equity shares, but academic researchers generally question the importance of this relationship between corporate dividend policy and stock prices. Why do some investors favor capital gains? To explain that, when a firm pays out dividends, all shareholders share in the dividend distribution, and all must pay taxes on those dividends as income. So let me discuss to you first the dividend policy irrelevance theory. It has been agreed that dividend policy has no effect on either the price of a firm's stock or its cost of capital. That is, that dividend policy is irrelevant. Thus, the shareholder is indifferent to a choice between dividends today or a claim on future earnings. And the principal proponents of the dividend policy irrelevance theory are Merton Miller and Franco Modigliani, or MM. They have argued that the only important determinants of a company's market value are the expected level and risk of its cash flows or the income produced by its asset, not on how this income is split between dividends and retained earnings. There is also an agreement that in a world of perfect capital markets, dividend policy does not affect shareholder wealth. And to give an illustration, let's have this simple case of Burnham Corporation. So Burnham is an all-equity firm that has existed for 10 years. The current financial managers plan to dissolve the firm in 2 years. The total cash flows the firm will generate, including the proceeds from liquidation, will be 10,000 pesos in each of the next 2 years. At the present time, dividends at each date are set equal to the cash flow of 10,000 pesos. There are 100 shares outstanding, so the dividend per share is 100 pesos. The value of the stock is equal to the present value of the future dividends. Assuming a 10% required return, the value of a share of stock today, and this symbol is Assuming a 10% required return, the value of a share of stock today, and this symbol is equals d sub 1 over open parenthesis 1 plus r close parenthesis raised to 1 plus d sub 2 over open parenthesis 1 plus r close parenthesis squared equals, we have to substitute the given numbers. So for this d sub 1, we have 100 pesos over 1.10 plus 100 over 1.10 squared equals 173.55 pesos. So the firm as a whole is thus worth 100 times 173.55 pesos equals to 17,355 pesos. So several members of the board of Burnham have expressed dissatisfaction with the current dividend policy and have asked you to analyze an alternative policy. Second theory for dividend policy is the dividend policy relevance theory. This theory viewpoint states that in a world with market imperfections such as taxes, flotation costs, and transaction costs, a company dividend policy affects its market value. Why do some investors favor capital gains? To explain that, when a firm pays out dividends, all shareholders share in the dividend distribution, and all must pay taxes on those dividends as income in the tax period. The firm may instead retain earnings, consequently causing share price to increase over what it would have been if the firm had paid dividends. Only shareholders who want the equivalent of a dividend will sell equity shares, thereby incurring. Second, dividend payments and dividend policy statements may impart information to investors about management's future expectations for the firm. This information content effect, which is the reaction of the market to dividend action, may affect stock prices favorably or unfavorably depending on the inferences and conclusions drawn by investors. So for example, when a company announces an unexpected increase in dividend, the stock prices rise in response to dividend increases. On the other hand, stock prices generally fall in response to dividend decreases. A dividend may increase and be interpreted by investors as a positive signal of the firm's future prospects and may be reflected in the stock price increase. So for the third argument, we have this clientel effects, which is the observable fact that stocks attract particular groups based on dividend yield, and the resulting tax effects should. This implies that investors are attracted to firms whose dividend policies meet their particular needs. Income-oriented investors and tax-exempt organizations may seek out firms that pay large cash dividends. Likewise, investors seeking to minimize their taxes or who do not need cash income may prefer firms that pay no or low dividends but that offer the potential for significant growth. And to give an illustration, let's have this simple case of Burnham Corporation. So Burnham is an all-equity firm that has existed for 10 years. The current financial managers plan to dissolve the firm in 2 years. The total cash flows the firm will generate, including the proceeds from liquidation, will be 10,000 pesos in each of the next 2 years. At the present time, dividends at each date are set equal to the cash flow of 10,000 pesos. There are 100 shares outstanding, so the dividend per share is 100 pesos. The value of the stock is equal to the present value of the future dividends. Assuming a 10% required return, the value of a share of stock today, and this symbol is. So under this concept, a firm should follow these steps when deciding on its payout ratio. First, they have to determine the optimal capital budget. Second, determine the amount of capital needed to finance the budget. For the third one, they have to use retained earnings to supply the equity component to the extent possible. And lastly, they have to pay dividends only if more earnings are available than are needed to support the optimal capital budget. Why do some investors favor capital gains? To explain that, when a firm pays out dividends, all shareholders share in the dividend distribution, and all must pay taxes on those dividends as income in the tax period. The firm may instead retain earnings, consequently causing share price to increase over what it would have been if the firm had paid dividends. Magnum has the following investment opportunities schedule. For Project A, they have an investment of 1 million pesos and an internal rate of return of 24%. For Project B, they have an investment of 600,000 pesos and an internal rate of return of 18%. For Project C, they have an investment of 400,000 pesos and an internal rate of return of 15%. For Project D, they have an investment of 500,000 pesos and an internal rate of return of 12%. And for Project E, they have an investment of 300,000 pesos and an internal rate of return of 10%. And that ends my discussion. The other topics will be discussed by my groupmates. Thank you for listening. So the firm's optimal capital budget consists of projects A, B, and C because the internal rate of return for each of these projects exceeds the firm's marginal cost of capital. The firm's marginal cost of capital is 14%. That is why projects D and E is not chosen or required because they only have 12% and 10% marginal cost. So these three projects A, B, and C, requires a total investment of 2 million pesos. 2 million came from 1 million investment from Project A plus 600,000 pesos from B and 400,000 pesos from C, which the ordinary equity share is 1,200,000 pesos. This ordinary share is generated from total investment of 2 million pesos times the percent equity, 60% equity. And if the dividends are treated as residual, the firm would pay the 300,000 pesos in dividends to maintain its optimal capital structure. This 300,000 pesos came from the total earnings available to ordinary equity, which is expected for the coming year, the 1,500,000 pesos minus the ordinary equity share of 1,200,000 pesos.